Hey traders, Nick here looking at financials, and today is, let's see, 5/24, the week of where we got the Fed minutes on Wednesday yesterday, and where the markets turned around from being the whole market, in general stock market that is, from being down to closing up on a day based on a dovish Fed minutes note, meaning they told us that they weren't in a hurry to raise rates any faster than they have been telling us, and in fact they could withstand some inflation a little bit higher than their target if it happens for an extended period of time. So basically, this is the Janet Yellen type of Fed is still behind us. So they're not the enemy of the stock market yet, at least not for now. So the market rallied, but at the expense of what? Rates falling. And therein lies the problem for the financials. So the financials fell today on rallying bonds. Rates fall, bonds rally. So that's the relationship. It's always the case. I've done several videos on that. So, and when, the dovish statement says, okay, we're not in a hurry, so rates kind of lose some of that momentum, and that allows the bonds to rise. So having said that, on a day where markets recovered from the lows of the day, even though it was kind of a challenging day on headlines that have nothing to do with rates, it was based on the North Korean situation. The XLF closed down 0.8%, which is the collection of mega banks, basically. So this is an opportunity for me. This is a short-term 4-hour chart. So we've traded the financials pretty successfully of late. Actually consistently forever, because they have value, tangible value, and therefore I can sell risk against certain levels very confidently. So there were a few breakouts that we caught recently, but in order to really evaluate the whole picture, the bigger picture, I go to at least a daily, which shows a 1 year worth of action. So we can tell that we're stuck in this box, which has been consolidating for months. I'm going to go to last November. So right around here, September, October, last fall, I should say, we determined that, okay, we as in the market as a whole, we had mispriced these for a long time. Up they go. Had a huge rally, like the whole market, and then we had the February correction, which is right here. Boom, retested the neckline from which they sprang. So this red line, it's not a hard line in the sand, it's a zone. Was tested once, tested again, multiple times. This is a really solid bottom right here. Then again here, but this was a V correction, so not as solid as this. But basically, this happened because of that. In other words, this V-sharp dip was completely negated because this established some precedent saying, hey, we've been here before, and the bulls decided that I'm going to defend it hard. Why? Because it's been tested here, and this was the neckline. So whoever fought over it here, bulls and bears, they fought over it here, they fought over it here, they're fighting over it here. And so I expect it to be support. So this is just a look at the whole financials. But you've heard me talk about single items in there. So let's say if I look at Citigroup, and I did issue a trade setup for me on Citigroup today. So, but this is the logic behind it. So here's a great bank, right? Been here forever. And banks have been forced to have fortress balance sheets, as they say. So their financial situation is a heck of a lot better than it used to be after the disaster that they caused with the financial debacle in 2008. So now they're overly cautious, okay? And now we have a better environment for them to operate in, because the Trump administration is loosening the rope, so to speak. So they're going to allow a little bit more looser rules, a little less tape. So it should result in lower cost, less administration, and hopefully more lending at higher rates. And the spread between the short-term rates that they borrow with the Fed and the rates that they charge us is going to grow. Therein lies the opportunity, the perception of opportunity. To me, they're going to move with the stock market. So if they divest from the stock market for a day or two because of rates, like if the market is falling and the rates are rising and the banks don't fall with the market, they're going to end up falling with the market eventually, and vice versa. So if their markets are rallying, and which is what's happening here, markets had intraday rally where the rates are continuing to fall lower. So that will also, they'll follow the market eventually. So having said that, so Citigroup is valuable. So why would I trade Citigroup? versus some other stock, not other bank, other stock, because I can calculate the value. So here's a company that's selling at a low PE, I don't know, teenager, let's say 13 PE, trailing PE, so that's actual results, past results, not forward PE. Forward PE will have some, assumptions of higher or whatever. In this case, this is actual results of past stuff. So if that's the case, then there's not a lot of speculation there. It's hardcore. And on top of it, it's selling it probably just over one book. So price to book. So it's selling at book value. So they're not giving any extra juice to the stock having some sort of an upside potential down the line. They're selling at what it's worth right now, book value. That usually is. So if you tell me, would you own Citi? Maybe, but would you own it 20% lower than here? Heck yeah. So that's the kind of thing that prompted today's trade, and if you have the details, you'd know what I'm talking about. So is it a loan? No. If I look at JP Morgan, JP Morgan is considered the cream of the crop. Whether it's true or not, I don't care, but it is a good bank. And same situation. They had a neckline from which they broke back last fall, tested it several times, and here they are falling on a day where they should not be falling that much because nothing changed in their fundamentals overnight or after this rally. So it's just price action. So if I'm long via short puts or put spreads, I'm not worried about it. If I'm long via stock, I'm probably a little bit more worried about it. And that's why I trade the way I trade, because I don't have to sweat the small ticks here and there. As long as I do my homework and as long as I know where the value is. So speaking of value, so here's one. I'll do it right here. I don't know the metrics off the top of my head. So I'll click price to earnings 14.15. That's trailing 12 month. Price to book 1.7, so a little higher than Citi, but still a darn good deal, I'd say. So again, the same spirit here, but this is one year. So I'd have to expand to higher time frames in order to take a look at the bigger picture if I wanted a bigger picture. In this case, I don't see the need for a bigger picture, but here it is. You're saying, oh my gosh, it's at near all-time high. So let's expand a little bit more. So just on a monthly basis. So this is how I expand back out. This would probably be more dramatic if I switched to Citigroup. Okay, now JP Morgan, I'm going to switch to Citigroup. So you can see Citigroup is nowhere near the highs it was before the debacle. However, it's a completely different bank right now. So the monthly picture here is not that representative. So if I zoom back in, leave it a monthly candle, but I'm zooming back in, then you can see, okay, now it makes sense. So that's that same neckline we were talking about. That's another neckline below it. So I have several levels, and it shows you that in the past, 2011 until now, there's another a very clear neckline somewhere around here too. So they usually overshoot down, they usually overshoot up. Somewhere in the middle lies the truth. So that kind of gives you an idea of how you can take a look at different companies from scratch. Okay, so there's another one, Wells Fargo. Here's one that creates its own problems. Okay, so it had a debacle recently, not too long ago, with actually fraud. They were actually cheating customers by pushing them into sales tactics. Regardless, it was the management problem. They were self-inflicted wounds, but they're working on eliminating those wounds. However, still, valuation purposes, it's still valued basically in the same profile. I bet you it's about 1.5 times book, maybe. Let's see. PE 15.5, price to book, 1.5. So still a decent deal value for the money. Again, here I see a neckline that has been defended several times, so they're all the same spirit. So if you tell me that the stock market in general is going to collapse, yes, these have a lot further to go lower, but they don't have as much fat on them as other stocks. So, for example, Netflix has a lot of fat on it. By the way, I'm happily long it and shared that trade. It has a lot of fat on it. So if the market's correct, this guy is going to correct hardest. A lot harder than the banks, let's put it this way. So if I'm worried about the stock market in general, I'd want to belong to banks before I belong something like Netflix. I am long Netflix for that, but short-term trade. So that's the point of, okay, how do I look at banks right now? Do they have value? Where's the risk? So when I'm going long a stock, or a ticker I should say, I look at the value that I'm going long. I look at the opportunity and the risk. So the opportunity is that it's going to be as good as it is right now, maybe a little bit better. And the risk is it may be a little bit worse, but there's no giant debacle. And if you know me and the way I trade, that's really the only thing I care about. I don't need a rally to profit. The way we trade with options is I just need it to hold support, period, end of story. So this is just a look at how financials are, from my point of view, an opportunity to generate income with little money, if not no money out of pocket. So even if I wanted to chase an upside trade like this guy right here, I would sell puts to buy calls, so to speak, but a little more surgically placed than that statement. But that's the concept. I bet on the debt. I sell risk against what others fear that is not realistic, and I use that money to try to capture an upside surprise of sorts. All right, Nick signing out. If you have any questions, you can email me at sellspreads@gmail.com. That's sellspreads@gmail.com.